Once a darling of Wall Street, these days J.P. Morgan Chase's reputation is tarnished. The latest in a series of scandals, two former employees are accused of trying to cover up last year's $6.2 billion derivatives trading loss. Javier Martin-Artajo and Julien Grout have been charged in both criminal and civil court with falsifying documents and wire fraud. Bruno Ixel, the trader known as the London Whale who actually ran up the losses, is not being charged in exchange for his testimony in the case.
The defendants deliberately and repeatedly lied about the fair value of billions of dollars in assets on J.P. Morgan's books in order to cover up massive losses that mounted month after month at the beginning of 2012.
The full knowledge of the losses came to light in April of 2012, highlighting the bank's risk-taking with its own and customers' money. Jamie Dimon, J.P. Morgan Chase's CEO, famously dug himself into a hole by calling reports of the giant loss a tempest in a teapot. He was given a rough ride by a Senate committee that concluded J.P. Morgan Chase hid massive losses, disregarded risk, and tried to downplay its own failure after the scandal first became public. An activity critics say that should never have been allowed to happen while the firm was engaged in commercial banking.
What we see from the United States, not just the regulators, but from the Senate as well, and now from the FBI and prosecutors, is a real willingness to go after what it sees as wrongdoing, which may create instability in the economy over the longer term.
The criminal case against these two traders is just one of a series of ongoing probes against J.P. Morgan by both federal and state authorities. Regulators with the Securities and Exchange Commission are also reportedly seeking a settlement with the firm over the London Whale case that could involve an admission of guilt as well as steep fines. Kristen Salumi, Al Jazeera, New York.